Welcome back to the deep dive. Usually when we sit down to crack open a file on a legacy corporate giant, especially in telecom, the vibe is, well, it's usually a bit heavy.
It's a bit grim, yeah. We're often talking about managed decline.
Exactly. The drill, trying to keep the ship afloat, frantically cutting costs, maybe hoping a merger saves the day. It's a conversation about survival.
Not revival.
Right. But today we are looking at something completely different. We're looking at a giant that seems to have found, I don't know, a hidden sprint button. We're talking about AT&T.
Mm-hmm.
The date is January 28, 2026, and they have just dropped their Q4 2025 earnings. And let me tell you, for a company that traces its roots back to Alexander Graham Bell, these numbers look surprisingly fresh. They aren't just hanging on.
No, they're posting their best consumer broadband growth in a decade. It's a fascinating case study in turning a battleship, really.
It is. And our mission for this deep dive is to look past the stock ticker and really understand the strategy here. How is this phone company re-engineering itself into a connectivity provider?
They're shedding their old copper skin to go all in on fiber and 5G.
And to do that, we've got a huge stack of sources: the earnings press release, the investor slide deck, and the full transcript of the call with CEO John Stankey and CFO Pascal Desrochers.
A lot to get through.
So let's dive right in. The numbers. They call them boringly good. But honestly, in this economy, boring is beautiful, right?
Boringly good is the highest compliment you can pay a telecom operator. In this industry, excitement usually means something broke.
Right, or you had a data breach.
Exactly. Boring means predictability. It means execution. So let's look at the headline stats. Revenue came in at $33.5 billion for the quarter.
And that beat expectations by, what, over $500 million?
Over $550 million. For a company this size, that's not just a rounding error, that's a statement.
It really is.
And on the bottom line, their adjusted EPS, earnings per share, hit 0.52 cents. The consensus was only 0.46 cents.
So they're earning way more than the market thought. But the number that really matters, especially for stability, is free cash flow.
That's the one. For the full year, it hit $16.6 billion.
$16.6 billion. That is a massive war chest.
It's an immense amount of liquidity. That's the money left over after they've paid for everything. Digging holes, building towers. It's what funds the dividends, the debt reduction. It gives them options.
Okay, those are the banker numbers. But here's the part that actually blew my mind. It's the consistency.
The streak.
The streak. On the wireless side, 1.5 million postpaid phone net ads. The lucrative monthly plans. They've done that for 5 consecutive years.
And think about how hard that is. The U.S. mobile market is basically saturated. Everyone who wants a smartphone has one.
My grandmother has too.
Right. So to add that many new customers, you aren't finding new people. You are stealing them. You're taking them from Verizon or T-Mobile.
And keeping them. It's not just phones either. Look at fiber.
1 million fiber net ads for the 8th consecutive year. 8 years. It's like clockwork.
And then there's this third category that popped up. Internet Air. Sounds like a sneaker. What exactly is that?
It's their fixed wireless product. So home internet, but instead of a cable in your wall, you get a little box that grabs a 5G signal from a tower.
Okay, so it's for places where it's hard to dig fiber.
Exactly. Rural areas, places like that. And they added 875,000 subscribers to that service, more than doubling their base in just 1 year.
So phones are growing, fiber is growing, wireless home internet is doubling. It feels like they're firing on all cylinders.
Yeah.
But I have to ask, is this just luck? Are they just giving away free iPhones?
That's the key question, and the answer is no. This is the payoff of a specific strategy they laid out 5 years ago. They call it being investment-led.
Meaning what?
Well, carriers used to buy customers with promotions, free Netflix, massive phone discounts. AT&T shifted gears. They decided to just win customers by having a better network.
So the product itself became the marketing.
Precisely. If your internet is fast and your calls don't drop, you don't need a free pizza to stay. You stay because it works. And that stickiness brings us to the absolute buzzword of this entire report.
Oh, I know what you're going to say. If you played a drinking game for every time they said this on the call.
You wouldn't make it past the intro. The word is convergence.
Convergence. It sounds so, I don't know, corporate. Let's unpack it. What does it actually mean?
Simply put, it means buying your home internet and your mobile phone plan from the same company. It sounds trivial, but for the industry, it's the holy grail.
And they seem to be cracking the code on this. I saw this stat. 42% of their fiber customers now also have AT&T Wireless. That's up 2 full points from last year. Why is that number so magical?
Well, think about your own behavior. If you just have a phone plan, maybe you'd switch to save $5 a month. It's easy.
Yeah, you can do it from your couch.
If your home fiber internet, which required a guy to come out and drill a hole in your wall, and your family's wireless plan are on one bill with a discount, are you going to switch?
Probably not. That sounds like a nightmare. Too much hassle.
Exactly. You churn less. You leave less often. CEO John Stankey had a great quote on the call. He just said, "Where we have fiber, we win."
Like a war cry. Where we have fiber, we win. But here's where I get confused. Why is AT&T better at this than, say, the cable companies? Comcast sells mobile plans now.
They do. And that is the billion-dollar question. It comes down to something called owner's economics. See, AT&T owns the fiber to your house, and they own the wireless tower down the street.
They own the whole stack.
The whole stack. The cable companies, they own the wire to your house, but for mobile, they usually have to rent network access from a carrier.
From Verizon or
Yeah.
AT&T.
Right. So the cable companies are paying rent to their competitor. Their margins are thinner. AT&T isn't paying rent to anyone. They're the landlord.
That is a huge competitive moat. If your competitor has to pay you rent, you win on margin every time.
And the data proves it. In areas where AT&T has fiber, their share of wireless subscribers is 10 percentage points higher than where they don't.
10 points. That is a massive swing just based on a glass cable in the ground.
It proves the thesis. Fiber sells wireless, and wireless sells fiber. It's a flywheel.
Okay, but to keep that flywheel spinning, they have to deal with the past. And that was another huge part of the report. Starting right now, Q1 2026, they're changing how they report their numbers.
They are. It's like they're drawing a line in the sand. They're splitting things into two buckets. One is advanced connectivity.
That's the new stuff, 5G and fiber.
The growth engine. It already drives 95% of their operating profit.
And the second bucket,
They're calling it legacy.
legacy, which is polite corporate speak for the old stuff that's dying.
That's it. The old copper-based landlines and DSL. And they're not just separating it. They're showing you how fast they're killing it. They call it the sunset plan.
The death of copper. It really feels like the end of an era.
It is, but from a business perspective, it's a necessary execution. That old copper infrastructure is a nightmare to maintain. It breaks. It's sensitive to rain. It costs a fortune.
And fiber is just better.
It's glass and light. It's resilient. It's cheap to run once it's in the ground. So by separating these numbers, AT&T is telling investors, look, don't let the dying copper business distract you from the rocket ship growth of the fiber business.
It's like cleaning out the attic so you can show off the new kitchen. And the numbers here are stark. They expect legacy revenue to drop over 20% this year alone.
And by 2029, they expect it to be, and I quote, immaterial.
Gone.
Gone. And that transparency is key. For years, the growth in fiber was being masked by the decline in landlines. Now, you'll see the new AT&T clearly, without that anchor dragging down the spreadsheet.
So, new reporting, new strategy. But they aren't just growing organically, they went shopping.
They did. Early 2026, they're closing two big deals. They're buying fiber assets from a company called Lumen and Spectrum from EchoStar.
Let's talk about Lumen. Why buy their fiber? Can't AT&T just dig their own?
You can, but digging is slow. You need permits. You have to deal with construction. Buying existing fiber is instant scale. This deal adds about $900 million in revenue right off the bat.
But the real opportunity isn't the revenue, is it? It's convergence again.
It's always convergence. Lumen was just selling internet. They didn't have a mobile network to bundle with it.
Right.
The penetration on Lumen's network, the number of homes that actually sign up, is only about 25%. AT&T's own network runs at about 40%.
So AT&T thinks they can just run the business better.
They do, but here's the kicker. Fewer than 20% of those Lumen customers currently have AT&T wireless.
Oh, I see. It's a fresh hunting ground.
It is a gold mine. They buy the customer for fiber, then they sell them a wireless plan. Suddenly, that customer is worth twice as much and is half as likely to leave.
A textbook synergy play.
Yeah.
And because of this, they're speeding up their build. They're ramping up to a run rate of 4 million fiber locations a year.
And don't forget the gigapower effect.
Gigapower, another great name. What is it?
It's their joint venture to build fiber outside of their traditional regions. They're invading new territories. And on the call, they said these out-of-region builds are performing better than expected.
So they know their brand travels well. That gives them confidence for the Lumen deal.
Exactly.
Okay, so they're building fast, buying fast, shutting down the old stuff fast. What does this mean for the bank account? This all sounds incredibly expensive.
It's capital intensive, no doubt. But remember that $16 billion in cash flow, they're generating so much cash they can afford to build and pay shareholders.
Wow.
They're planning to return over $45 billion to shareholders between 2026 and 2028.
45 billion. That is just a staggering amount of money.
It is. And they're not just relying on revenue growth, they're cutting costs. Another $4 billion in savings by 2028.
Are we talking layoffs?
Some of it is efficiency, sure, but a lot of it is technology. AI handling customer service, optimizing truck rolls. But the biggest cost saver is shutting down the copper.
Right, getting rid of that maintenance nightmare.
It saves billions.
Now, there was one specific financial detail that caught my eye, mostly because of the name. The CFO mentioned something called the One Big Beautiful Bill Act. What on earth is that?
Laughs. It does have a unique name. It's a piece of tax legislation. We don't need to get into the politics, but the financial impact for AT&T is very real. It's saving them about $1.5 billion in cash taxes.
And what are they doing with that extra $1.5 billion?
They're being surprisingly prudent. They're putting it directly into the pension plan.
The pension plan, that sounds responsible.
It is. It improves their free cash flow outlook for the future because it pre-funds an obligation. It's a smart balance sheet move that clears the decks for the future.
Smart. Okay, so looking at guidance for the next 3 years, what are they promising?
They're forecasting adjusted EBITDA growth of 3-4% this year, rising to over 5% by 2028. And for earnings per share, they're looking at double-digit growth annually.
Double-digit growth for a telecom giant. That's the definition of a turnaround.
It is. It signals they're moving from the heavy lift phase into the harvest phase where the profits roll in.
Now, before we wrap up, let's hit a few fun nuggets from the Q&A. I always love the Q&A. An analyst asked about a foldable iPhone.
Ah, yes, the eternal rumor.
And I loved management's answer. They basically just downplayed it. They said, current foldable users are a niche group, and it's not going to make 80% of people switch carriers.
It was refreshingly realistic. They're focused on value, not device hype. A fancy phone might drive sales for a month, but a solid fiber connection keeps a customer for a decade.
They're betting on the pipe, not the gadget.
Exactly. Whatever device you have, foldable or holographic, it needs a strong network to work.
Then there was the buffet analogy from the CEO. And no, not Warren Buffett, a food buffet.
Right. He was talking about buying Spectrum. He said historically it was a buffet rush where everyone fought for the same thing, bidding billions.
And he's saying the buffet is closed.
He thinks so. He believes the industry is moving to a more strategic approach. You only buy what you need to feed your network. It's a sign of a maturing, rational industry.
One last small detail, bad debt. They mentioned it ticked up slightly. Should we be worried people aren't paying their bills?
Not really. The CFO clarified this. It wasn't that people are struggling to pay the monthly bill. It's that AT&T is selling more expensive phones.
Ah, so when you finance a $1,200 phone versus a $600 phone, the risk is just higher.
Precisely. It's a mix shift, not an economic crash.
That's an important distinction. Okay, so let's zoom out. We've covered the numbers, convergence, the death of copper, the acquisitions. What's the big picture here? Why does this matter?
The big picture is that we are at the very front end of a massive technological shift, and it's driven by AI. Everyone talks about AI models and chips, but AI needs data, massive amounts of it.
And that data needs a road to travel on.
Exactly. And that road is fiber. AI requires dense fiber and symmetrical connectivity. Your upload speed needs to be as fast as your download. That's something cable struggles with.
But fiber excels at.
It does. AT&T is positioning itself as the infrastructure backbone for this new AI era. They aren't just selling you a way to watch Netflix. They're building the pipes for the next generation of the internet.
So that's the bet.
That's the bet. And the final takeaway is simply this. AT&T is betting the entire house on convergence. If you have their fiber, they're coming for your wireless business. If you have their wireless, they want to dig fiber to your house.
They want to own the whole relationship. And with the numbers they just posted, it looks like that bet is paying off.
It really raises a provocative thought to close on. With copper dying, we are witnessing the final extinction of the telephone company. That concept is dead. We are seeing the birth of the connectivity utility.
Water or electricity.
Exactly. You don't have two water pipes coming into your house, you have one. So if AT&T hits, say, 50% convergence in a neighborhood, half the homes have both their services, does the competition even stand a chance there?
Wow.
The economics become so efficient for AT&T they could undercut anyone on price and still make a profit. It could fundamentally change the competitive landscape.
That is a wild thought. We might be moving toward a world where your internet provider is as singular as your electric company.
For better or for worse.
They're better or for worse? Well, on that note, I encourage you to go look at your own internet bill. Are you part of the converged statistic yet? Something to think about. Thanks for diving deep with us today.
See you next time.